presentation of approaching retirement. We're going to go through just a slideshow presentation talking about some of the high points, some of the conversations that we have with clients around the retirement and some of the decisions they need to make as we get closer to that retirement date. I'm going to pop into my PowerPoint presentation here and share that screen with you so you can see it too. So one of the things that we think is very important is to have expert advice as you get closer to that retirement date. Many people have different things they need to navigate, and most people have Social Security and Medicare. Many other people have 401k decisions, COBRA decisions with medical, pension decisions in some cases. So a lot of times it helps to have an expert, somebody that's been through this before, to have that conversation with. I know in doing this for 20 years, I've had many, many conversations with people who have retired, and those people only had to have one of those conversations. So it's good to talk to somebody that's been through it before and seen different situations. So really, I guess this presentation just talks about some of the things that we talk about with people as they get closer to retirement. Certainly not everybody has every topic on the top of their mind, but there's certainly a few things in here that probably pertain to anybody that is looking to retire. Our goal is really provide sound financial advice to people. A lot of times I say, if I were you, I would look at doing this. And that's really the best advice I think I can give is to try to put myself in your shoes and try to help you make good decisions. We try to help identify goals. And a lot of times I say we want to try to match your money to your goals. If you have a goal of retirement and your money lasting for 20 years into retirement, keeping the money under the mattress isn't going to help because you're going to lose pace with inflation. On the flip side of that, if you want to buy a car, or you're going to retire next year and you need $30,000 of income, putting that money at risk isn't always the right decision either. So we want to make sure that we match the money that you have to the goals that you have. And then, obviously, if you have any questions, this is what we do. Jared and I and Maddie and Tammy work with people every day. And if you have questions or you want to talk about retirement, we can certainly offer that to you. So when we retire, our financial focus shifts a little bit. We change that mindset of accumulating and saving to withdrawing. And that's not always an easy thing to do. And we'll talk about that a little bit. And then, obviously we want to generate income and have money that lasts you your lifetime so that you're able to do the things that you want to do and be financially independent. So the first thing we're going to talk about is preparing for the unexpected. And we'll get into envisioning your retirement, talking about investments, and then how to distribute some of those assets, which isn't a cookie cutter solution, but certainly talk about the advantages and disadvantages of a few things. So preparing for the unexpected. One of the number one concerns that people who are retiring or near retirement have is their health and longevity, and also health insurance and those type of things. So it's probably the number one topic that we talk to people about, certainly over the past 5 years. So this is an interesting statistic. If husband and wife reach age 65, there is an 83% chance that one of them will see age 85. There's a 62% chance that one of them will see 90. And there's a 34% chance that one of them will see age 95. Again, that's a healthy 65-year-old couple. So you can see that longevity is certainly something we need to plan for. Part of that longevity is trying to hedge inflation. And inflation is a real thing. Today, groceries cost $50. In 30 years, a bag of groceries is going to be $120. That's at a 3% inflation rate, which is close to historical numbers. Today's retirement portfolio that's worth $1 million is really only worth $400,000 in 30 years, just to the purchasing power of those assets. So, and I know there hasn't, quote unquote, been inflation in recent years, but there are certainly pockets of inflation, and we don't have to look any further than the housing sector to see that with the cost of materials and the cost of buying homes today. Healthcare is obviously something that is on top of mind. A 65-year-old couple who retired in 2019 may need $300,000 to cover health expenses in retirement. And I don't necessarily think that that's the exact number, and it's a bit misleading because we do have Medicare as a country to help cover some of those things. But I will say any couple and anybody that's had a parent that's been in a long-term care facility knows that if there's any assisted living or 24-hour nursing care, that is a very expensive thing that can add up very quickly. So this just kind of talks about a crisis plan and how that might impact a portfolio. I'm not going to go into depth on that. It's obvious if you spend a whole bunch of money on long-term care, it's going to shorten the duration of how long your money is going to last. One of the things that a lot of people are concerned about is the market and the predictability of the market. And you can kind of see that year between 2005 and 2009, there wasn't great returns, but those decades around those times, there has been. And that's why I think it's very important to have a good, sound investment plan as we get closer to retirement. And we'll get into that here in a little bit. What this is really leading into is sequence of returns. So this shows somebody investing, retiring with $500,000 invested. The orange line being somebody that experiences loss in their portfolio the first few years of withdrawal, and the other being someone that has gains in their portfolio. So basically these 10 years are flopped. Year one of investor A is -5, where year 10 of investor B is -5. So just kind of shows a sequence of returns and how that can impact your portfolio. And obviously as you take $35,000 withdrawals, if there are losses in there on the front side of things, when that money hasn't had a chance to grow, that can have an impact on your portfolio in the end, which we'll get into some investment ideas later. Envisioning your retirement. How do you want to spend your life? Will you and how will you support your lifestyle? Do you plan on spending what you spend or more than what you spend today? Or do you plan on downsizing or spending less into retirement? And really the biggest question is, what are you going to do if you haven't accumulated enough? I tell people usually you're going to need close to 100% of your pre-retirement income the first few years of retirement. And really because hopefully your health and the lifestyle that you want to lead isn't drastically different in retirement than it was the last few years of your working years. Maybe even a few more vacations than you typically would do prior to that. So we want to make sure that we have enough saved to maintain that lifestyle. Different sources of retirement income, obviously personal savings and investments, and a lot of that revolves around your 401k and the things that you've done at work. Social Security, and that being a core piece of your retirement earnings and income, and then continued employment earnings. I think a lot of people are finding, especially if they worked a job that wasn't real hard on their body, they're finding that, boy, I want to do something in retirement. I don't want to just sit around the house and get old. So if you have a job, a service-oriented job, you might find yourself in good health and really looking for some continued employment. Personal savings and investments, I would say that the bulk of people we deal with have money in one of the top three things, and maybe the most in their employer-sponsored plan. So those are tax advantage vehicles. Those are qualified accounts, is what in the investment world what we call them. So 401ks, 403bs, IRAs, Roth IRAs, and in some cases people have annuities out there. Taxable vehicles are are those accounts that maybe investments that are not inside of your IRA that you have access to prior to 59 and a half. Obviously CDs and banks checking and savings account are other places people save money. And then other non-tax advantage investments, real estate, gold, people have all kinds of different things there. Social Security. So back in the early 80s, Social Security or prior to the early 80s, Social Security full retirement age was age 65. At that time, the Social Security Administration and our government decided that with longevity, we needed to push those full retirement ages up. So if you were born in 1943 to 54, they moved that to age 66. And then if you're born in 1955, they bumped it up to 66 and 2 months, 1956, 66 and 4 months, again, 57, 66 and 6 months. In 1958, your full retirement age is 66 and 8 months. In 1959 is 66 and 10 months. And then if you're born in 1960 or later, we are currently at a full retirement age of 67. As a general rule of thumb, for every year that you take that early prior to your full retirement age, you're going to get about an 8% reduction in your benefit. Okay, about 8%. It's not exact, but that's just a general rule of thumb. For every year that you wait, you're going to get about an 8% increase in your benefit. So those are just kind of showing you, if you waited till age 70, you'd actually, if your full retirement age was age 66, you'd actually get 132% of your full retirement benefit if you waited till 70. This talks about annual benefits and claiming. I'm not going to get into that. It just kind of shows you what your monthly benefit versus annual benefit and what that might be if your full retirement age is 67 with a $2,000 benefit. Oh, if you took it at age 62, what that would be reduced to. Obviously, each person, is a different month, and you just have to calculate that with Social Security, or we can help you do that as you get closer to that date. Continued employment earnings. 80% of people that are going into retirement plan to have some sort of part-time income into retirement, but actually only 28% do. So that really tells me as a financial planner that I need to even emphasize more that we need to save more into retirement, because even what you think is going to happen isn't necessarily what's really going to happen. Investment mix. So like I mentioned before, one of the things that we talk to people a lot about is matching your money to your goals. We want to make sure we establish that time frame. We want to make sure that we discuss your risk tolerance. And then more importantly, what are your goals? What is your objective with that money? Is it to grow for kids' college? Is it to grow for your retirement? Is it to grow for to pass on to the next generation? Is it for a vacation home? There's a lot of different goals that people have. But like I said, matching the investment that we make to the time frame and how long you have until you need it is vital, especially in today's world of near 0% interest rates. So even a 5-year CD, you're only getting 1%. So if you're putting your money for 10 years from now in a 5-year CD, it's not really a good way to match your money to your goals. We want to make sure that we're helping you do those things. Asset allocation, the simple way to put this is owning a diversified portfolio in a lot of different assets. And when I say a lot of different assets, I don't mean with some at work and some here and some at a different broker. I mean looking at the entire picture and making sure that, making sure that your investments are diversified and you also have access to them when you need access to them. So, I don't want to put money that I might need for my kids' college when I'm 50 years old into my 401k because I won't have access to them at that point. I don't want to, put my 401k in a stable value getting 1% if I'm 20 years or 15 years from retirement or even 10 years from retirement. I want to make sure that I'm diversified in assets that match the risk that I'm taking and the runway I have to reach those goals. So this just kind of walks through two different portfolios, one being a conservative portfolio of 50% bonds, 20% cash, and 30% stocks. And you can see the best year, the worst year, and the average annual return. And then a more aggressive portfolio over the same time period of 75% stocks, 5% cash, and 20% bonds. The best year, the worst year, and the average annual return. Now, over that 19 years, they returned close to the same, but there were pockets of time where they did much different. And I would argue that as you get closer to retirement, making sure you have some assets that are more conservative makes sense. But there's also, God willing, if you're 65 years old and that's your retirement date, you're going to still need some money 20 years out. So you still want to have some money that's invested aggressively to be able to take advantage of the markets and hedge inflation. Talking about a well-diversified investment mix, and there's 4 different investment alternatives there at the bottom: cash, bonds, stocks, mutual funds, and ETFs. There are many, many more than this. There's real estate, there's annuities or fixed annuities. There are, CDs. There's an endless number of investments out there. What we feel our job is to really find the ones that fit you the best, to fit your risk tolerance, to fit your time horizon, and then to educate you on those options, rather than telling you what to do or what the best thing is to pull a few things together and have an educated conversation so we can make a good decision about it. Taxes are important, and I have a feeling they're going to become more important in the future. So we want to make sure that we're being as tax efficient as possible, especially as we look at Medicare and MNsure if you're retiring prior to age 65. In the state of Minnesota, actually nationwide, if your income is below a certain amount, you have a lower premium for your health insurance. So we want to make sure that if that's going to be the case, if you're going to retire prior to Medicare age, that we have access to some assets out there that are not taxable, so we can try to control your tax bracket a little bit to help you with those premiums. So ordinary tax rates, qualified dividends, long-term care tax rates are lower. And then obviously if you have tax exempt bonds or Roth IRA, you might not pay any taxes on those things. So we want to make sure that we have different assets, not only diversification and invest in different assets, but also invested in different vehicles that will treat your taxes differently. Some of the things we talk to clients about in income producing vehicles, fixed income investments, income oriented mutual funds, ETFs, that would be stock or dividend paying stock funds or even bond funds. Dividend paying stock, so if you look at 3M, they might be paying a 3% dividend rate right now. So those type of investments will help supplement your income. Tax exempt investments might be municipal bonds, those type of things. And then income annuities, typically when you think of annuity, think of pension. There are some income annuities out there that will pay you an income stream for your lifetime without risk of losing or running out. So there's a lot of different things that we can do. Obviously, you can throw real estate in there. A lot of people, buy real estate to produce income too. Now, we used to do what's called a bond ladder, and you would buy that bond ladder over 2 to 10 years. In the longer term the bond, the higher interest rate it would give you, and you would ladder those bonds to come due when you needed the income. Unfortunately, in today's world, bonds aren't paying that much. In fact, a 10-year bond and a 2-year bond might be pretty close to the same rate of return or yield on those things. So we've gotten creative and used some different things out there that are paying a little bit better than what a bond is. And if that's the case, that's a conversation that we can have with people. But might be fixed annuities, fixed indexed annuities. There are even some ETF ladders out there that you can buy that can produce some income. So those are things that you can look at, but case by case, we're going to sit down with you and educate you on the options that are there to try to make the best decision we can. Dividend paying stocks, like I mentioned, a 3M would pay a dividend, and if you hold that stock, they're going to pay you income just to hold that stock. Typically, those dividends are taxed more favorable than ordinary income that you take just right from your 401k. Tax exempt investing. So, municipal bonds are basically what tax exempt investing is. If you're a higher tax bracket, investing in municipal bonds might be right for you. Again, unfortunately, bond rates aren't real great right now in the year 2021, but in some cases that still makes sense if you're a conservative investor in nature. The last thing here, choosing a distribution method for tapping your assets. One of the things that we try to explain to people as they get closer to retirement is if you spend a lot, you're going to run out of money fast, regardless of the rate of return you're getting. And this is showing a $500,000 investment. And let's just say you're 65 years old. If you take 10% of that money out, which is $50,000 a year, and you inflate it at 3%, so you need 50 grand, a 4% return, your money only lasts about 11 or 12 years. And an 8% return, less than 15. So regardless of what kind of return you're getting, you can see the 8% return is double the return. It's not necessarily about the return, it's about how much you're spending. So one of the things that we give for homework as you get closer to retirement is putting pencil to paper and really figuring out what you spend. And not guessing, not saying, oh, well, I had an expense like this year, but I'm not going to have it next year, because typically those expenses continue to come, right? I mean, if your furnace goes out this year, maybe it's your roof next year, maybe it's a grandkid needs money the following year. I mean, there's always something there that's going to be pulling on you to spend that money. So we really need to know within a pretty tight range how much you're going to spend. And that's really the hard part of the financial plan and a retirement plan, is knowing how much you're going to spend. Because whether if you retire with $500,000 and you spend 50 grand a year, whether that money lasts you 11 years or 13 years, we can't even control that rate of return. What we can control is how much you spend or how much you're saving today to get to that amount. Again, there is no perfect strategy. Your decisions will, based on a number of factors. How much you have at retirement, your actual returns, but most importantly, and I would highlight number 3, how much you're going to spend. That's what we can really control. I mean, rate of return is not guaranteed. It's going to go up and down every year. Hopefully we get over a long period of time, we get a 6 to 8% return in markets, but that's not guaranteed. I can guarantee you if you spend 50 grand a year, it's probably going to be 50 grand a year next year too. So we want to try to make sure we know what we spend. Things to consider: your health, right? How long, your life expectancy, both your personal health and the longevity in your family. The 4% rule, we'll talk on that a little bit. As a rule of thumb, we try to tell people, if you want to retire around 60 years old, if husband and wife are both alive at that time, you run a pretty likely chance of one of you making it to age 90. If you take 4% of your portfolio out per year, you run a low likelihood of running out of money at age 90. And that's factoring in inflation too. So somebody that has $1 million, if they take $40,000 a year, every year, it's likely they will have still a balance there in 30 years. Okay. And that's using some assumptions with inflation and a rate of return, but that takes away the sequence of returns, and it kind of takes out some of the guessing out of that game. Three-tiered strategy. I'll get into that in a minute. Life expectancy, I'm not going to get too deep into that, but really based on how long your family longevity is or what your personal health is, If you think, well, I'm 60 years old, but I'm not going to make it to 80. Nobody in my family has. I've had some major health issues. Well, then maybe you could go a little bit higher than 4%, right? If if we have a bad market, then that might mean it doesn't last quite as long. But that's really the case in any portfolio. If the markets are bad, we have to reassess what you're taking out. The 4% rule, again, I just kind of explained it, but if you take $1 million portfolio and you take 40,000 out, that money is likely to last you at a 5% return adjusted for inflation over 35 years. If you take 6%, a little over 20 years. If you take 8%, right at about 15 years. The last thing I'm going to talk about a little more in depth, and that's a 3-tiered strategy, and I call it the buckets of money approach. And really, as you get closer to that retirement, or even before, while you're working like I am, I have a buckets of money approach for myself. You want to have some money there that's available, and that's there to cover expenses in the first 2 to 3 years. That doesn't mean you need 2 to 3 years of expenses if you have income, but if you are retired, you want to make sure that you have money there to cover those expenses over 2 to 3 years without much market fluctuation. The midterm bucket of money is really from 3 to 10 years. We want it safer, right, than the markets, but we still want to get a little bit better rate of return, and we don't need as much access to that money. That's kind of where bond ladders traditionally have come into play, right? You can't really access the bond because you have to wait to maturity, but you don't need to because you have that short-term money that's already there. And then your third bucket, your long-term bucket, is more than 10 years, and that's primarily equities and stocks, companies that you own or that are owned in a portfolio. And the reason we want that for a 10-year bucket, because we know next year that those stocks could go down 20% or more, right? But if we have a 10-year runway, it's likely that those companies will be profitable and you'll get a decent rate of return there, hopefully better than what the bonds and the cash has done. But really what that stock portfolio is to grow your portfolio, but also hedge inflation to cover the cost of poker and covering food and gas and clothing and all those things that go up in price. So, the advantage of it is it's manageable, provides a way to balance your current income. The disadvantage is it does require some active management. Some of it depends on market performance and, what products are available and what they're paying you to own them. This walks through a 3-tiered strategy, a buckets of money strategy. And really, tier 1 is that conservative at 3%. You're withdrawing 45,000 income, and for 5 years until it's depleted. Bucket 2, you're getting a little bit better rate of return, maybe 4%. It's worth about 200,000 in 5 years, and then you can invest that in the conservative bucket so you can replenish that 200,000. And then your longer term bucket of money is hopefully growing at 6% over time. That's not going to do that consistently every year. But in 10 years, it's worth 850, and then you rebalance your strategy and replenish those first 2 buckets. Identifying what to spend. Consider the taxable assets before deferred, and that really depends on your situation. If you're looking to keep your income down for tax credits for your health insurance, maybe you go the other way around. Liquidate winners before losers. Again, depending on where your portfolio is and what the taxability is, that's another decision. So there are some things you really need to think about as you liquidate assets, and that's what we do every day, and that's what we're here to do. That's what we quite frankly we enjoy doing. So having those conversations with a financial professional, even if you are on the right track, sometimes just having that conversation with somebody that's seen it before gives you a little bit more confidence that you're doing the right thing. In retirement, confidence is everything. The other thing I will say to that, and I've seen this many times, is husband or wife takes care of all of the finances. And when something happens to that person, the other one is fairly lost. So finding a financial professional that you know and trust, it doesn't have to be me, it doesn't have to be Jared, somebody that you know and you trust to take care of that spouse when you're gone is vital. because fear is a real thing, especially when you lose a spouse. And fear in money, I have seen it so many times, that the spouse doesn't know what they have, doesn't understand what they have, and is literally lost without that person making money decisions. So even if you're doing it yourself now, find somebody that you trust, that you can tell your spouse to say, hey, if something happens to me, go work with so-and-so, because I'm confident they'll take care of you. Retirement plan distributions, really there's a few different things you can do when you retire. Most employers allow you to keep it there. If you take a lump sum distribution, you're going to pay tax on the entire balance. Some people determine that they want to take systematic withdrawals. Some people just decide to take a pension or a lifetime annuity. And then a lot of times we help people do an IRA rollover to get it away from that former employer so that we can control the investments, we can control the buckets of money, and we can also help people take income and send them income on a monthly basis to supplement, the Social Security or the pension that they already have. This goes through an annuity. I'm not going to go in depth on that. If you do have a pension, these are some decisions that you need to make, and we can help you make that. But it's kind of sometimes difficult to give an example of that because every pension is so different. Which distribution method is appropriate for you? At the end of the day, every decision is a personal decision. And everybody's situation is so different. So we want to make sure that we take all those things into consideration. We factor in health, age, not just age of the retiree, but age of their spouse, or if they're taking care of dependents, what their ages are, what their risk and their comfort with risk is, whether the market's going to go up or down, or they want to just keep it safe and stable, what they need or what kind of spending they do. And when you're 60 years old, you have a pretty good idea of what kind of spender you are. Either you're a saver or you're a spender. There's not a lot of gray area between, and helping those and coaching those people through that. And then obviously monitor taxes as much as we possibly can, and working with your accountant to do that stuff. The advantage of the IRA rollover is it continues tax deferral. So if you do retire and you want to roll that out of your 401k, move it into an IRA, you don't have to pay taxes on it until you actually start taking distributions from that IRA. When we do that, there's typically more personalized investment strategies that we can do. If you have multiple employer plans, we can consolidate them into one IRA. And versus a pension, a lot of times people take a lump sum from a pension because they can't pass those assets on to their kids. So they want to make sure the IRA goes to their wife or husband, and then eventually to the kids. RMDs, required minimum distributions, that just changed about a year ago now. When you turn age 72, any pre-tax account, you will have to take distributions from. That's required by Uncle Sam. You can postpone the first one, but for the most part, you want to take it out by December 31st of each year, in the year you turn 72 and every year thereafter. If you do not take that distribution, it is a 50% penalty. So that's something that we help people with, to make sure they've taken their minimum distributions. And there is talk about that minimum distribution age going to 75. At some point, there's actually a bill, I think, being introduced here this month. But until that happens, we don't know. A qualified charitable distribution is money after you hit age 70 and a half. You have the ability to make a qualified charitable distribution to a charity and not have to pay taxes on that IRA distribution. So if you are 70 and a half and you are making any charitable contributions and you have pre-tax money, it is my recommendation that you make those contributions from your IRA. And the reason I say that is because very few people, when they hit 70 and a half, have enough itemized deductions to actually deduct contributions. So if you just take even if it's just $2,000 from your IRA, give it to the church or a charity, you don't have to pay taxes on that $2,000. And that gives you more money in your savings account to spend. Roth IRA, obviously the advantage of the Roth is it's after-tax money. You don't have to pay taxes on it when you withdraw it, as long as it's there for 5 years or to age 59 and a half, with that, whichever is longer. It does not affect Social Security or Medicare premiums, and you can withdraw those contributions at any time. So it's my recommendation, most people who are even working, if they're eligible, that they make Roth contributions of some amount to get that 5 years started, and then also to get that tax-free growth over their lifetime. So obviously, you can do it yourself, you can work with us, or you can procrastinate. I would say the worst of those is definitely procrastinate, right? Whatever it is that you need to do, find out, talk with somebody. If you have a pretty good idea of what you're doing, put it into practice and take care of it, because the longer you wait, typically either the harder it is to get to that retirement age, or it's hard to unwind some of those things that you're doing. So make sure that you have sound advice, that you're educated on that, and then get started as soon as you can. That's all I have. If you have questions, certainly reach out. I am available. Jared's available. Email and phone number are on our website. Website is www.keithmyers.com. We certainly appreciate your time watching this video and hope you have a great day.